Focus now to a big CNBC TV18 exclusive where sources tell us that the GST Law and Fitment Committee proposes that the input tax credit on input goods and input services lying unused as of 31st of March will be reversed by the real estate developers. Timsi Jaipuria first joins in with the details. Timsi?
Well, that's right. What we understand from sources as of now is the fact that the agenda is almost set for the upcoming GST Council meeting. And the GST Law and Fitment Committee has proposed that the only way forward for a smooth transition on real estate, that is from old rates to the new lower rationalized rates, is that the ITC on the input of goods and services which is lying unused as on 31st March 2019 should be reversed by real estate developers through their return form, that is GSTR 3B. And government feels that the ITC benefit available to the real estate developers will actually lapse and die over there itself. And from 1st April 2019, any new invoice raised by the builders will have to be charged at 1% for affordable housing, again without ITC, and at 5% without ITC for other than affordable housing. Now remember, the 34th GST Council is all set to meet on March 19 to finalize the transition norms for the reduced rates on real estate. Now meanwhile, the government has also assessed an impact of this change, and this assessment actually is a little worrisome for the home buyers because the cost of affordable housing could go up and the cost of luxury housing could drop once this transition happens. Also, developers might go in for repricing of projects, and it will be tough for the government to track the procurement clause that they have put in, which says that 80% of procurement needs to be done by registered dealers. Also, this entire scheme of things might result in a sudden increase of anti-profiteering complaints. So it's a mixed bag that government will have to take a tough call on in the upcoming GST Council meeting. We'll keep you posted.
Okay, thanks a lot for that, Timsi. So the input tax credit, which has not resulted in houses being sold, lapses. That's a bit of jargon for those who are not familiar with how GST works. And so we've got a GST expert with us. We have MS Mani from Deloitte, and we also have Gulam Zia, the Executive Director at Knight Frank. Mr. Mani, first, if you can explain exactly who is going to be hit? Is the consumer going to be hit? Is the real estate company going to be hit? What's happening?
Ideally, no one should be hit. Ideally, it is good for the consumer and good for real estate companies as well. But the way I look at it is, as far as consumer is concerned, it's certainly going to be beneficial. Because rates dropping from 12% to 5% and rates dropping from 8% to 1% is certainly going to be...
But that is old news. We already know that GST is 1%. But now the real estate guys cannot make use of the input tax credit. What does that mean?
Now, it is not only the real estate guys. There is a general principle which says that you are eligible to take an input tax credit only if you are liable to make a tax payment. And this is not for real estate alone. This is across the spectrum. So there is no business in GST law which is permitted to take a credit if they don't pay a tax.
But they're going to pay 1% GST tax,
okay.
No?
Now the 1% rate and the 5% rate are referred to as composition rates or lower rates. Okay. We have a similar situation for restaurants as well. So on restaurants also the rate was lowered, to 5%, and they are not eligible to take a credit. Now, when we look at the lapsing of the credit, essentially what it means is that in respect of houses which get sold after 1st April, but which have been constructed prior to 1st April, whatever is a tax credit balance, that goes into some kind of a suspense account, if I may put it. But my sense is, since that expenditure has been incurred by the developer, possibly the government will be very kind to the real estate sector when it comes to the transition rules. They may not want the entire amount to lapse because that will be a hit to real estate bottom line. Some of the listed real estate players, are not doing very well because of a combination of slow offtake and RERA and various other things. Now, with this, one of the things that we have to bear in mind is, I heard your colleague saying that in respect of, affordable housing, the hit will be, much more, and in respect of premium housing, it may be less. That, I would say, depends on the mix, in the sense, when we talk of premium versus affordable, premium housing is in certain places where the land cost is very high. So the land cost as a proportion of the cost of the project is very, very high. In Bombay, for example, sometimes as high as 70%, right? Now, the land does not attract GST at all.
Okay.
So when we say that the cost will shoot up for premium, we have to keep in mind what is the proportion of the land cost to the construction cost. Now, in the construction cost, what proportion of the construction cost relates to luxury housing? Possibly 5% or 10%, because you have to, make the tower, and then you make the amenities and fittings, much better. So how much would those cost? Maybe 5%, 10%. To that extent, yes, there will be a, hit.
Okay.
But at a broad level, this will be very good for consumers, certainly. As far as real estate players are concerned, they will have to now undergo a loss of credit to the extent of 5%, 6%, whatever is there.
But would there be any industry estimate on how much credit they would have come?
I don't think
it's
so.
Very difficult.
I don't think so. But to my mind, the issue that needs to be focused on is the fact that cement, which is a very large item for real estate, continues at 28%.
Exactly. So that's what I think. They would have taken a lot of credit for the cement they used, but now that lapses.
That lapses. So there is now a very good case for someone to say that, look, on real estate sector items, since the final output to the consumer is at 5%, should we rationalize the rates of cement and steel and tiles and stuff like that? That is, the larger case.
So that argument apparently has been made many times to the GST Council, but the Council is unable to reduce it because, as it is, the collections have not been so robust.
Revenue considerations.
Okay, so there could be a hit to the real estate company, but we can hope that the government will provide some relief to transition it.
Absolutely.
Let's get in Ghulam Zia, the Executive Director of Knight Frank. As we were trying to ascertain from Mr. Money, do we have any estimates of the quantum of the income tax credit which is unutilized by the real estate companies? Any estimate as of 31st of March or even up until now?
Not really. An expert like Mr. Money is unable to get to the number you're asking about. We are just real estate players. Definitely, we may not have any idea about how much of it will be lost. So, not the right person you're asking this question to.
All right, Ghulam, the expectation is that the government will be a little kind to some segments of the real estate which is deeply affected, and maybe allow them, not ask them to pay up all the credit that they have taken. In any case, do you think that any of the builders can pass on this loss that they suffer to the home buyers?
Well, prima facie, there is no case. Right now, where the market is, it's very tough for a builder to pass on any additional burden to the buyer. So whatever increase or the loss of ITC that we're talking about from developer side of it, the way I look at it, it will be an additional cost that a developer will have to take for the moment till such times markets are looking better. But in the interim, the way I look at it, whatever is that 5 to 7% additional hit that they'll have to take will be getting out of their margin straight away. And that's a concern right now, because I said the buyer is not in the frame of mind to pay that additional burden right now.
Okay. Mr. Money, you said that the government may be kind to the real estate sector. Exactly how will they do that?
See, the intention is not to make, the credits lapse. So that is not the intention of, the tax reduction at all. And therefore, if the intention is not to allow the credits, to lapse, then possibly we can have some kind of a formula which can be worked out, depending on in a particular tower or a building, what are the proportion of apartments which have been sold, what are the proportion of apartments which have remained unsold, what was sold earlier and what is sold subsequently. On that basis, possibly proportionate credit can be, offered.
Okay, Ghulam, I wanted to come to you on something slightly unconnected. There have been a couple of reports telling us that the real estate, especially home buying, has probably troughed. We had a CLSA report, and then we had Morgan Stanley also picking up some real estate, especially residential companies or residential dependent real estate companies as their buys. The argument being that that market has troughed out. Would you agree with this premise?
Well, most of it is based on the recent changes that have happened in the GST regime, where we're making such kind of observations are pretty open out there. However, it's a bit too soon to say that, because for sure, we have noticed lots of buyers lots of prospective buyers reaching sites of the developers, looking at show apartments, expressing interest to purchase. So the footfalls, if I can use that term, I don't know if it is right for real estate, but footfall on the developers' offices and the site has shot up in last about fortnight or so. But will that convert into businesses? Only time will tell, because I'm told 1st of April onwards we'll actually see the impact of the GST, the shift in the GST regime coming in for the real estate. So till such times the interest converts into purchases, I would say I would be rather cautious to take that as a outcome that things have started turning around. While there are signs, but till such times it is not converting into checks signed, I would be very cautious to say that the industry is turning around.
But it's a good sign, at least the footfalls have increased. Ghulam, Mr. Mani, thank you very much for joining in. Lots of interesting insights coming in on this particular topic.